Hello everyone, Steve Lentz here with Discover Options, and welcome to this presentation of three different market timing reports. The S&P 500 Condor Butterfly timing report for those who trade advanced options strategies like condors and butterflies. Also, the S&P 500 Bull Put Spread timing report for those doing bull put spreads, bullish credit spreads. From that perspective, and also for the statistically minded, the directional likelihood report for the S&P 500. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Now, these reports are all for Friday ending June 2nd, getting ready for Monday, June 5th. I'd appreciate it if you would subscribe. Click the little subscribe button, and also we have a free ebook. If you want, you can click the link, give us your information. We'll get this ebook to you, co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. Here is the market condition as of Friday. The market took off and had 2 straight days of upswing days where the highs were higher than the previous day, and the lows were higher as well than the previous day. All this is happening above the 50-day simple moving average, and the 15-3 stochastic is really high and trending upward above its %D. So all that combines for a market condition that really has been quite common, inclusive of consecutive conditions like this. You can see those 3 straight bars there, for example. This has happened 481 times since January of 2000. Now, the non-consecutive, it chops it down to well under 300, of course, and so, but we'll get into that a little bit more. But we're talking here about a condition that's occurred a lot, so we have a huge database then of occurrences to tee off on. Let's go to the first market report. This is for those of you that trade condors and butterflies, pretty advanced stuff. You can make money no matter which way the market goes, which is great. But here, let's just go through the report. So since Jan of 2000, there have been over 4,300 daily closes of the SPX. Okay, so this is the narrative here. Of these 4,300 plus, 65.1% have been favorable bars for selling premium, where the actual 21 bar movement of the index was less than the SIBO Skew adjusted implied movement of the index. Okay? So what that's saying is that the market moving forward in time has not moved as much as what was being implied by the options. And that's a favorable thing to happen if you're selling options premium through condors and butterfly strategies. Now, also during that time, since Jan of 2000, our current condition that I've just expressed has occurred, as I mentioned, 481 times. Of these 481, 71.1% have been similarly favorable for option premium selling. So the benchmark historically was 65.1. Of the 481 times that matches our current condition, 71.1% were favorable for doing condors and butters. So that's an edge then of about 6%. 71.1 minus 65.1 benchmark. See that? So statistically, it's slightly more likely than usual that Friday's bar will end up being a favorable one for market neutral option premium selling. And so that's the environment we're in. Works out to be quite favorable, giving us an edge then for selling premium neutrally. Okay, now let's take the perspective of the bull put spread trader. This is where you sell out of the money put premium and then you cover it. Now, I mean, you could do it naked if you want, but then typically a bull put spread would be for a more conservative way to do this, especially for the Reg T folks. You then go further out of the money and purchase the same number of contracts to cover the short contracts that you did. And so you could do this at a net credit and you get the whole credit assuming the market finishes above the strike at which you sold those puts. Okay, so we really want the market to either go up or stay where it is, or at least not go down so far. All right, that's real, and that's what's beautiful about this strategy. And in fact, at Discover Options, we have a way of hedging this even further to enhance your risk-reward profile here. So here's the narrative here on this report. So since Jan of 2000, there have been over 4,300 daily closes of the SPX. Now, of those, 82.7% were favorable for selling out of the money put premium. Now, that means a standard deviation away. Okay? A standard deviation away, where the actual 21 bar downside movement was less than the SIBO skew adjusted implied movement to the downside. Okay, so what we're saying is that 82.7% of the time, the market did not drop as much as what the option premium was implying it could on the downside. Now, also during that time, since Jan of 2000, our current condition has occurred 481 times. Of those 481, 86.3% of the bars were favorable for selling out of the money put premium, a standard deviation away. So the market went down and struck, with our, current market condition, of those 481 times, it only went down and struck a standard deviation below where the market is currently, basically 13.7 times, or excuse me, 13.7%. So this implies in a put option premium selling edge of 3.6%, 86.3 minus 82.7. Okay, so statistically, it's more likely than usual that Friday's bar will end up being favorable for selling out of the money put premium, standard deviation away. Okay, so that's that. Let's go to the market likelihood report, and what you see here, and I just want to alert you to the items here. Let me explain this quick. Upper 5, upper 10, 15, lower 5, lower 10, lower 50. What we're talking about here is price distribution. Price distribution. And so if you were to look at the close, okay, what we do is we divide these, we create price distribution bands. And so these are set a standard deviation away at a 5-day level. So these are 5-day bands set one standard deviation away. And the question is the market going to go up and hit the upper band or the lower band, or wobble around and stay in the middle? So we have 5-day bands, we have 10-day bands, and we have 15-day bands. All right, now let's go and take a look at the report then. Let's look at the benchmark up here. Historically, over 4,342 occurrences, price hit the upper 5-day band 29.6% of the time, the upper 10-day band 23.3, 15, 23.1, the lower 5-day band 29.3. Now we're using a 20-day statistical volatility here to determine the width of the bands. The lower 10-day was 29%, lower 15, 31.9%. So basically, when you come back here, let me go back here, price will strike these bands anywhere from 23 to 29% of the time. Basically, the rest of the time it wobbles around and doesn't go and hit those bands, the 5, 10, and 15-day. And that is just the typical distribution of price. Now, what we're going to do is look at our current market condition. Non-consecutive occurrences are set at 264. Of those 264 non-consecutive occurrences, price would go and strike the upper 5-day band just 10.2% of the time. Hugely less than the benchmark. Just flip a coin over the course of those of these 17, 18 years. Price would strike the upper band 29.6% of the time. After our current market condition has occurred in the past, it only strikes that upper band a little over 10% of the time. Strikes the upper 10-day band 12%, far less. Look at that, far less than the benchmark. Strikes the upper 15, 13.6, again far less. The lower bands get struck less often as well. So what is this telling us? This is telling us that after this market condition has developed in the past, there's a greater chance, there's a greater likelihood that the market will be less volatile than normal, because it's only striking the bands, especially on the upside, a little bit, quite a bit less often. On the lower bands, it's striking it less often, but not to the degree as on the upside. And so if you were to weigh in bullish or bearish here, which way would you go? Well, statistically, it's showing us that the upper bands are struck far less often than the lower bands. So we would tend to lean a little bit bearish here. Does it mean that price isn't going to go up? Well, no. 10, 12, 13% of the time it did go up and hit those upper bands, a standard deviation away. But that's far less than the benchmark and far less than on the downside, hitting the bands on the downside there, which it was still less often as the benchmark. So this is a picture of lower market volatility, a likelihood of lower market volatility, and a likelihood that if you had to pick a side, you would pick the bearish side, given these statistics here. Now, we do run this in a scenario where if price on Monday exceeds Friday's high, that occurred 164 times in the past, and you can see similarly the upper bands are struck less often than normal. The lower bands are struck less often than just the baseline here of the 264. So that's a picture of lower market volatility, and in particular now the bulls and the bears are evenly distributed more so. Now if price exceeds Friday's low, we can see that the upper bands are struck a little bit more often. Isn't that interesting? But the lower bands are struck more often than the bullish bands, and much closer to the benchmark then. So I hope this presents some good information for you in terms of what the likelihoods are on the market, moving up, down, or wobbling around a bit. Now, I do like to recast these bands. Instead of using a 20-day statistical volatility, we'll use the VIX, which is a higher number typically than statistical volatility, and we'll use the Skew adjusted VIX, meaning that the upper bands, because out of the money call implied volatility is lower than the out of the money put, the call band, the bands above the close will be closer to the close, and the ones beneath the close, these three down here, will be farther away. So when we recast the bands using the Skew adjusted VIX, we notice that the bands get struck less often than 23 to 30% because the VIX is higher. Okay, but even so, you still have the same pattern that we experienced earlier. That if the market, based on these bands, the upper bands are getting struck quite a bit less often. The bearish bands down there are getting struck more often, but clearly still less often than the benchmark. And you can see the pattern. If price goes above the high, similar pattern where the bullish bands are struck, far less often, and then the bearish bands similarly so, except for this lower 15 one. Okay, price exceeds the low from Friday. Okay, the bearish bands getting struck less often by quite a bit. Same with the bearish bands, although not to the same degree. Okay, so that is the report for the likelihood. I'm Steve Lentz with Discover Options. So I hope you have a great week trading. We'll be back next weekend. Same bat time, same bat channel. Take care. Bye-bye.